Good evening and welcome everyone. We are here to discuss PNB Housing Finance Q3 and 9-month financial year 18-19 results adopted as per Indian accounting standards. With me, we have our leadership team represented by Mr. Sanjay Gupta, Managing Director, Mr. Shaji Varghese, Executive Director Business Development, Mr. Ajay Gupta, Executive Director Risk Management, Mr. Nitan Desai, Chief Operations and Technology Officer, Mr. Anshul Bhargava, Chief People Officer, Mr. Sanjay Jain, Company Secretary and Head of Compliance, and Mr. Kapish Jain, Chief Financial Officer. We will begin this call with the overview and performance update by the Managing Director, followed by an interactive Q&A session. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual development and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 2 of the investor presentation available on our website. With that, I will now hand over the call to Mr. Sanjay Gupta. Over to you.
Thank you, Deepika. Good evening, everyone. Welcome all to our Quarter 3 and 9 months financial year 18-19 earnings call. Before I get down to business, I'd like to wish your families and you a very happy, joyous, healthy, and a meaningful New Year 2019. The third quarter of the financial year 18-19 witnessed high level of volatility and liquidity concerns in the debt capital market, particularly on short-term borrowings. Anticipating the liquidity challenges that we have been speaking about during various earnings calls over the last 1 year, we maintained additional liquidity of 6,000 crores as on 31st December 2018. Having said so, our proactive approach of maintaining excess liquidity in the balance sheet and operational rigor enabled us to operate in a business-as-usual mode during Q3 of 2019. As a consequence, during the quarter, we disbursed loans worth 9,300 crores across products and business segments and cumulatively over 27,500 crores during the 9 months period of the financial year 18-19. On the liability side, we raised over 22,500 crores during Quarter 3 of financial year 18-19, utilizing multiple avenues like ECB, NHB refinance, deposits, securitization via direct assignment, commercial papers, etc. Among the recent borrowings of Quarter 3, financial year 18-19, the pertinent ones are 3,500 crores of loan sanction from the National Housing Bank and 3,324 crores of fresh ECBs. In this regard, we express our sincere gratitude to the National Housing Bank for their trust and belief in the company's robust operations. Borrowings via commercial papers was restricted to rollover of existing facilities. Hence, during the quarter, the company net borrowed long-term funds, thus improving its ALM gap across all buckets. On the deposit side, the company continues to be the second largest deposit-taking HFC in the country. We strengthened our deposit franchisee and have seen strong retail confidence with 3,500 deposit applications in April of 2018, moving to over 9,000 deposit applications in December of the same year. This is a robust and dependable engine to mobilize low-cost and sticky resources. Let me now talk about the financial numbers for the quarter ending 31st December 2018 and 9 months of financial year 18-19. The figures are on a consolidated basis and are compared with the same quarter during the previous financial year. During the quarter, the company registered a healthy double-digit growth over Q3 of financial year 17-18. The net interest income was up by 35% at 558.2 crores and profit after tax was up by 32% to 303 crores. The spread on loans for Quarter 3 of 2018-19 is 256 basis points and the net interest margin is 306 basis points. The company also registered healthy double-digit growth during the 9 months period of 18-19 over the same period of financial year 17-18. The net interest income was up by 30% at 1,453.8 crores, and profit after tax was up by 38% at 811.8 crores. The spread on loans for the 9-month period of 18-19 is 227 basis points, and the net interest margin is 285 basis points. The gross margin net of acquisition cost for the 9-month period stood at 326 basis points against 338 basis points during the same period of 17-18. The OPEX to average total assets for the 9 months is at 69 basis points compared to 58 basis points during the same period of the previous year. This includes incremental ESOP cost of 3 basis points and employee cost of PHFL, which is our subsidiary that largely houses our DSTs, cost which was amortized under the IGAP is 6 basis points. Further, ongoing branch network expansion, the cost undertaken includes in the growth expenditure. If we only consider our business as usual and exclude incremental ESOP and PHFL costs, the OPEX to ATS is 58 basis points. The cumulative ECL provisioning on 31st December 2018 is at 435.6 crores. In addition to the ECL provision, we have 156.5 crores as a steady-state provision for unforeseeable macroeconomic factors. As a prudent management practice, we added 11 crores in this pool during Q3 of financial year 18-19. The return on assets for the 9-month period of 18-19 is 1.51% compared to 1.56% during the same period of the previous year, on average gearing of 9.19 times against a gearing of 7.15 times during the previous year for the same period, resulting in an expansion of return on equity to 16.22% for 9 months period of financial year 18-19 vis-a-vis 13.28% for the 9-month period of the previous year. The closing net worth as per Ind AS as on 31st December 2018 stands at 7,162.2 crores. Now let me talk about the business performance. During the 9 months of the financial year, we registered 14% increase in loan file logins compared to the corresponding period of the previous financial year. The disbursements registered 13% growth year-on-year at 27,518 crores vis-a-vis 24,455 crores during the 9-month period of the previous year. The assets under management registered a growth of 38% to 79,737 crores as on 31st December 2018. Geographically, West is our largest market with 38% of assets under management, followed by North and South at 31% each. We have limited presence in East with 3 branches, 2 in Calcutta and 1 in Bhubaneswar, which forms a part of the North Zone. The company during 9-month period of 18-19 securitized loans worth 5,800 crores of its through the direct assignment route. The total outstanding loans assigned amounts to 9,019 crores as of 31st December 2018. Net of this assigned loans, the loan assets are 70,717 crores as on 31st December 2018, representing a healthy growth of 28% year-on-year. Housing loans constitute 70% of assets under management, and now non-housing loans constitute the balance 30%, and is in line with the business mix maintained in the previous several years. In the housing loan segment, individual housing loans constitute 57%, and construction finance for residential properties constitute 13% of the assets under management. In the non-housing segment, loan against property constitutes 16% of the asset under management, lease rental discounting, non-residential premises loans, and corporate term loans constitute the remaining. As part of a geographical expansion, 16 branches were made operational during the 9 months period of this financial year, totaling to a 3-digit number of 100 branches with presence across 60 unique cities. The company also services its customers through 26 outreach locations. The company also made 2 underwriting hubs operational during the period, totaling to 23 underwriting hubs as of 31st December 2018, catering to the branches and the outreach centers of the company. During the 9 months period of 18-19, out of the total individual housing loan disbursement, about 23% by value was in less than 25 lakh category, which can be termed as affordable housing. With increase in our branch network in Tier 2 and Tier 3 cities, we look forward to increasing the contribution of the affordable segment in our individual housing loan portfolio. Part of this portfolio also qualifies as priority sector or PSL, a portfolio which can be sold off to banks at fairly attractive price post they attain the minimum seasonal requirements of 6 months. Gross NPAs as a percent of the loan assets stands at 0.47% as of 31st December 2018 compared to 0.42% as of 31st December 2017. The gross NPA at AUM level is 0.45% as of 31st December 2018. In our wholesale book, we have 0 or nil NPA as on 31st December 2018, which is due to the stringent norms for customer selection, credit underwriting, and project monitoring mechanism. On our resource profile, 30% is contributed by non-convertible debentures, 17% by bank lines, 17% by deposits, 12% by direct assignment, which is securitization, 11% by commercial paper, 7% refinance from the National Housing Bank, and 6% through ECBs. On 9th of January 2019, India Ratings downgraded our NCD rating from AAA to AA plus stable. The rating action reflects change in India rating approach whereby the credit assessment is based on the standalone intrinsic credit profile of the company compared with the erstwhile approach where the rating agency had factored in the credit strength of the sponsor, Punjab National Bank. This change in the rating approach is in light of the weakened credit profile of the sponsor as well as its stated intention to divest its stake in the company. No concern otherwise has been recorded by India Ratings with respect to financial performance and soundness of the business. The capital risk adequacy ratio as of 31st December 2018 stood at 14.49%, of which Tier 1 capital is at 11.37% and Tier 2 capital is at 3.12%. This is as per IGAP and does not consider the impact arising out of Ind AS adjustment. In line with our philosophy to enable the marginalized community in becoming capable and self-reliant, we worked in the area of skill enhancement, daycare centers, education, and healthcare under our corporate social responsibility program known as Saksham. As an update to the stake sale, we received a joint letter on 13th November 2018 from PNB and Quality Investment Holdings, QIH, the Carlyle Group, informing about QIH decision to withdraw from the joint sale process. On the same day, we received another letter from the Punjab National Bank on their intention to independently sell their stake in the company. The process is currently underway. With this, we would now open the floor to the question and answers. Thank you very much, everyone. Thank you.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1 on your touchtone telephone. The first question is from the line of Nitesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir.
Hi, Nitesh.
Hi, sir. Two, three questions. First is how one should look at the spreads given that we have done huge amount of securitization assignment in this quarter. So on a like-to-like basis, how is the spread movement if we would not have done assignment in this quarter?
Well, okay, can you, I will answer one by one.
Sure,
so
sure.
I will give you all the time. So securitization is the business as usual for the company. And we have been maintaining that about 10% of our total assets will be securitized year on year. And this year, in the beginning, we had indicated that that figure is at about 7,000 crores. As of now, we have done about 5,800 crores. So we have headroom of about 1,200 crores for quarter 4. We make sure that we do a very balanced securitization of the pool, which has home loans and LAP both, so that the product mix in the retail segment does not go haywire. So to say in the future, what are we going to do? Plus minus 2%, as I keep saying, we have large operations. We will maintain a 10% portfolio via the direct assignment route. And this will be now done on a quarter-on-quarter basis. So it is not that, Q3 had some amount of securitization, so Q4 will not have. It is now business as usual. So not to worry on that count.
But just to understand the spread trends.
Okay, so supposing, because of Ind AS, you upfront the spread for the life of the loan and add it to your interest income. If that was the case, if you want to know that figure, it is about 1.95% or 195 bits on the entire portfolio.
Okay.
But you should recollect that the portfolio which we securitize, and I do not have that map, is a vintage portfolio which is at a higher sort of a spread. So hypothetically, if we do not securitize, then this 195 bits can be around 200 bits.
Sure. Secondly, on OPEX to asset ratio, how one should look at that number?
Okay, now this is again an impact of the Ind AS. And I was, also grilled by my board, and they have all the right. And I was very well prepared. The impact is primarily because of two reasons. In Ind AS, the entire ESOP valuation gets upfronted. Now that has an impact of about 28 crores in this financial year. So, and the other one is that if you recollect, all our direct sales team used to be on third party as of the previous year, which is now sitting on a subsidiary company. Now, under Ind AS, the fixed salary of these folks, which are about 3,500 people, cannot be amortized. Only the variable component can be amortized, and that has an impact for the 9-month period of about 33 crores. Now, if you summate both of them, they will be in excess of about 60 crores. And if you minus that 60 crores from 415 crores, then you will be left with something like 315 crores. And if you compare 315 crores like to like with 283 crores, the upside of the OPEX is not 47%, but it reduces to about 11%. And if you want to convert this to OPEX to ATA, it will be somewhere around 58 bits, which is as good as anybody else. And also on the CIR, it will move from 21.27% to something like 17% if you, do the same math there. So it is because of the accounting law or the regulation and the change which has brought about this increase, both in OPEX to ATA and in CIR.
And thirdly, on this line item net gain on fair value changes, which is around 52 crores for this quarter. So should we include that in net interest income? Is it on investment portfolio that we are earning? And it will be very volatile quarter on quarter. If I understand
these are basically HTM, and this is, these are in liquid funds, so not to worry on it.
Okay. Thank you, sir. That's it for my time.
Thanks a lot. Have a nice evening.
Thank you. Before we take the next question, a reminder to our participants that you may press star and 1 to join the question queue. The next question is from Ronak Raichuria from Asian Market Securities. Please go ahead.
Hello, sir. How are you?
Hi, Ron. Good evening. How are you doing?
I'm fine, sir. Sir, I have just one question. I wanted to know what is your 2-year lag gross NPA?
See, 2-year lag gross NPA is an annual exercise and is not a quarterly exercise.
Okay.
So if you see as on March, our 2-year lag NPA were at about 0.6% vis-a-vis the industry of 1.6. And that delta spread is only increasing. And I think the same story is going to remain as of 31st March 2019.
Okay. So you are saying that we'll be much lower than the industry.
Yeah,
right?
Yeah. And that is why, the rigor, the operational rigor, especially when there is a slowdown and I shouldn't be saying, but, there is a liquidity sort of a crunch, gatekeeping and monitoring has become a bigger role than what it used to be.
Correct.
And I am very hopeful that we will come back to a sterling 2-year lag comparison when CRISIL comes back to its annual exercise.
Right. So my second question has got to do more with what's the outlook on the real estate segment, because real estate typically is a very levered business, and because of the liquidity crunch from the NBFCs as well as the cost of funds rising, there will be some kind of a slowdown in the real estate segment as well.
John, I will say I'm not so much concerned, and I've been maintaining this over the last 1 year, on the yield curve movement, because the bench rates, looking at the sentiments and the inflation, the CPI, etc., I think the bench rates are going to come down, but the spread is going to increase because of the fear of credit default. Now, hence the rates of interest, effective rates of interest are not going to come down. What we have to be really looking very carefully is the liquidity, which is the bloodline of real estate per se, or the build environment. And that I think the regulatory authorities, the government and all, should be taking care of to make liquidity their priority and not the rate of interest.
Right. So, but do you feel, so as you said that, you just mentioned that the gateway keeping has become a very important aspect of lending now. So obviously most people are cautious and therefore are disbursing lesser. Is that so even with us?
No, so we have not disbursed lesser in comparison to Q2 of this financial year. In fact, we are 11 percentage points higher. We are a good 14% higher than the same period of the previous year. And if you remember, Q3 of 17-18 was a sterling quarter for us, where we had done 2 large LRD transactions amounting to or summating to something like 1,680 crores. And I had told the investment community or the analyst community that this quarter is an aberration. Don't take it as business as usual. Even if you were to compare from Q3 of the previous year to Q3 of this year, we are having a positive growth. So I'm not saying that because of gatekeeping, the disbursements or the business is slowing down, but the business processes or the rigor is far more than in a BAU situation.
Okay. So there's no stress as such. I mean, you're saying the wholesale gross NPAs are 0. So you...
when I say 0 in English language, it is 0 in Arabic, in numerics, in Roman numerics.
I'm not questioning this. I'm saying that, so with the added rigor itself, okay, so our book is very, very robust.
I think, Rohan, this wholesale business has become a phobia, and there's a fear psychosis behind it. As a person, as a veteran in the industry for the last 32 years, take my word, if wholesale credit stops, hypothetically it becomes 0. Your retail will be first belly up, then wholesale. Because the developers will not construct. Hence, on the sold inventory, they will not be able to raise new demands. Hence, their interest servicing will be jeopardized. And if they don't construct, they will not be able to sell.
Right.
So, and retail business is a rich man's game, is a rich man's hobby, is a passion, is a romance. Till you don't have the right mix in a large portfolio between corporate finance and retail, I don't think, and that's an open challenge which I throw to everybody. Have large operations of this magnitude, only retail, and give me an ROE of 18+%. It's an open challenge. First of all, reach the scale by doing only retail. Which good developer will let a lender even come inside? What is our purpose? What is our relevance in the economy? We are making the supply side more versatile. And if we don't fund the supply side, so where will the demand come? It will be just inherent demand. It will never fructify.
Correct. Correct. That's it, sir. That's it.
Thank you. Have a nice evening.
Thank you.
Thank you. Participants who wish to ask questions may press star and 1 on their touchtone telephone. The next question is from Bhaskar Basu from Jefferies. Please go ahead. Bhaskar Basu from Jefferies, you may go ahead with the question.
Yeah, good evening.
Hi, good evening, Bhaskar.
Good evening. Just a couple of housekeeping questions. Firstly, on the incremental yield, could you kind of share what your incremental yields are?
Incremental yields are far smarter than the previous ones, and as a consequence of which, it is about a good positive of 10.27, 10.28 on the entire portfolio.
And if you can get a breakup between...
I don't think this, call surmounts to that sort of a micro details and products. And you can get in touch with Deepika if you are so keen. Because segments will have different yields, products will have different yields. So I don't think that's required on this call.
Okay, just to get in perspective, 10.27, for the current quarter, obviously the quoted yield at 10.77 has been distorted because of the assignment income. So what would be the like-to-like underlying?
So that is what I say. Assignment is going to be a business as usual. Assignment is going to be a source of funds like deposits.
No, I understand, but just to get a perspective in terms of like-to-like, apples-to-apples comparison for the quarter versus where you are on an incremental basis. Because the 10.77 which is disclosed includes assignment, my understanding.
Yeah, so I don't think, that delta will be so high. And just give me a second, and I will come back to you on that. I don't think, probably then I'm wrong, because the direct assignment will not have an impact of 50 bits. Because we have not done that sort of a large portfolio assignment. So probably the incremental yields on the products and the product mix that we are doing will be a little higher than 10.25.
Okay. Okay, fair. And also, just to get a perspective of the growth, so we have the numbers for AUM. Can we kind of get the growth numbers on an AUM basis for...
As I keep saying, my AUM will grow. We are not working in vacuum at about 1.5 to 1.75 of the industry average.
No, basically, for this quarter, for the various segments, I guess...
Bhaskar, we will maintain a very, very judicious mix, and we are not going to change our product mix or our segment mix at all.
Okay.
And we have not done it in the last 28 quarters. I don't expect that we will do it in this quarter.
Okay, fair. Thanks, that's all from my side.
Thank you.
Thank you. The next question is from Nishin Chavate from Kotak Securities. Please go ahead.
Yeah, hi.
Hi, Nishin.
Hello, sir. Two things. One was just one clarification. Did you mention that your NIM, which is at around the reported NIM of 3.06, becomes 1.95 if you...
No, it's not NIM, it's the spread.
The spread. So the spread, which is at around 2.56 that is reported, becomes 1.95. I think that's what you mentioned.
No. that was on the incremental business. Right? So it is not that 2.56 has got 60 basis points impact of securitization. Right? So it is not that.
9 months. That's a 9-month period, 1.93, and that corresponding number is 2.27.
Okay. So Deepika sort of proves me the corresponding number is 2.27.
Sure. So had you not done the securitization, you would have been 1.95 versus 2.27. That's what you're saying.
Yeah, for 9 months. Yeah, for the 9-month period, correct.
Okay. Sure. Just wanted your commentary, two things. Wanted your commentary on, what is really happening with the real estate developers, and what are you really seeing at the ground level in terms of, some of the other players slowing down, and, how is that really affecting the business, and how are really banks responding in this environment?
See, one is certainly what we are seeing is there is a change of gears amongst the developer community. So, I think we have been wishing for pan-India brands to emerge. I think within a passage of 18 to 24 months, we will have about 25-30 brands across the country, which will be worth sort of investing in. And the model which is going to emerge is not the development or the DM model, but is the joint development model, or the JD, as we call it in our parlance, where the developers will be putting their skin in the game in the project, rather than just working on revenue sharing. So I think thanks to RERA demonetization and tightening of the liquidity, that this consolidation is becoming more and more visible. Obviously, we will have to, even on the retail front, and I keep saying that retail can become more dangerous because of the operational rigor. So if today I have about 167 unique relationships in my corporate finance book, I have 2 lakh unique customers in my retail book. Now, you just imagine how horribly high the rigor and the operational girth will be required if these people start, behaving in a different fashion than what they have been behaving till now. So it is I think, worth is weight in salt that wholesale or corporate finance should continue to sort of even moderate the stress on the retail part. And as I keep saying, gatekeeping has become more and more significant. It's consuming more of our time. Operational robustness, digitization, enterprise system solutions, robust standard operating processes, upskilling people, keep on modernizing technology is the way forward. Because gatekeeping has become significantly more important than just, risk buying or risk purchase. And we have kept away from category B and C developers. Now, B and C, we internally classify them. And I think going ahead, we will have to only focus on A category type of developers who would be emerging as the pan-India players.
And on the retail side, competition in terms of some of the players slowing down, and how are really private banks so basically some of the NBFCs who still continue to do well, some are slowing down, and the role of private banks at this point of time.
Yeah, that's the truth of life. You know it as well as I know it. What value can I add to it? And that is what I say. And you people have been asking me in various investor conferences, what are your fears? And I keep repeating 3 Ps. My people, my peers, I wish them all the very best, and the press, the media.
Sure. Thank you very much and all the best.
Thanks a lot. Have a nice evening, sir.
Thank you. The next question is from Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hello.
Hi.
Hi, good evening, sir.
Good evening.
So first question is on the corporate term loan book, which is of almost 3,600 crores. Can you just throw some light on that, please?
What light do you want on that?
Because you have mentioned that it's commercial, residential, because typically
It is not commercial, sir. This is corporate term loan. The full form of CTL is corporate term loan.
No, so just if I come to this slide.
Okay, so these are 100% secured loans. The security value or the DCR in the credit parlance will be at least 1.5 times. And the repayment of these loans are through earmarked, escrowed cash flows of very marquee brands. I can't reveal, the brands. And let me assure you, this is a very safe bet. The only difference between a CTL and a CF is that CTL is like a working capital. It is fungible at a holdco level, not at a project SPV level. So it is a more robust, and these are basically given to listed and highly rated companies.
Okay, on the slide number 41, when we have given some details about the corporate CTL, wherein we have given the ratio of residential and commercial of 60-38. So
yeah, when we say commercial, these will be basically corporate houses of these marquee brands. Their own offices, their commercial buildings which are, occupied by marquee tenants, those type of commercial buildings.
Okay, and the second question is on the average gearing. Now we have reached almost to 9.2 times. What would be the comfort level from the management in terms of...
I will not
regulatorily, obviously, you can go down, you can increase significantly from here also, but just what's the range, ballpark range that you are looking at?
So basically, I will maintain it at about 11 times is when we start preparing for the next capital raise, and by 12-13 times we will have the capital inside the company. Even at the IPO level, we were geared at about 15 times.
And when we talk about the gearing of 11 times or 12-13 times, do we include the off-balance sheet AUM or it's only on...
No, it is only on the portfolio on balance sheet.
On balance sheet, okay.
Yeah.
Thank you and all the best, sir.
Yeah, thanks. Have a nice evening.
Thank you. Before we take the next question, a reminder once again to our participants that you may press star and 1 to join the question queue. The next question is from Mohan Pradeep, who is an individual investor. Please go ahead. Mr. Mohan Pradeep, you may go ahead with the question.
Yeah. Hi, good evening to all. I just have this question regarding this stake sale. I know you mentioned the stuff is coming, the process on. I just want to know...
Can you speak a little louder? I can't hear you, sir.
Sorry, sir?
No, you're not clear.
Can you hear me?
Yes.
Can you hear me, sir?
Yes, I can.
Hello?
Hello, we can hear you.
Can you hear me, sir?
Yes, we can.
Yeah, I just thought, I just wish to know regarding the stake sale, will it be done this financial year?
See, we are not running the process, Mohan. PNB is running the process. The way they are doing it, it looks by the end of this financial year, they would be done and dusted. But I cannot give you a commitment. I am not running the process.
Okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Pravesh Kochar from Blackstone. Please go ahead. Mr. Pravesh Kochar from Blackstone, you may go ahead with the question.
Hi, good evening, sir.
Hi, good evening.
I just had one quick housekeeping question. The income that we have recognized on assigned loans this quarter of 152 crores, that corresponds to 2,700 crores of securitization, is that right?
Yes.
And last quarter when we did 3,000 crores.
That 152 crores.
And last quarter for 3,000 crores we recognized 62 crores. So is there an increase in spreads this time or how does that work?
Yes, there is. So you are right. 115 has got about 50% home loan and 50% retail LAP.
So if you could just throw some light on what is the spread we have received on these assigned loans versus last quarter?
It is not a single transaction. These are multiple transactions with multiple buyers. And there are different segments, there are different vintages, and there are different products. So it would be very difficult to say one number.
Understood. And for these calculations, you assume an average tenure of what, 7-8 years, or?
So as I'm saying, it will depend on the
home loan,
level, on months on book, on product, and on segment, because the behaviors change with product, segment, and vintages.
Okay. Thank you, sir.
Thank you.
Thank you. Participants who wish to ask questions, please press star and 1 on your touchtone telephone. Next, we have a follow-up question from Ronak Raichura from Asian Market Securities. Please go ahead.
Yeah. Hi, sir.
Hello.
Sir, my question is, I wanted to understand the rationale behind the restriction of the assignment to 10% of a portfolio. So what's the, if it's ROE accretive, why wouldn't we want to do more assignments?
No, it is a self sort of a restriction. Like in the wholesale, we keep saying that, the wholesale book plus minus 2% will be around 20% of the total portfolio.
Right, but actually,
these are just housekeeping questions.
Correct. But is there a rationale behind it? Why would...
Yeah, the rationale is obviously that the rating agencies also feel comfortable if you are not going berserk on your assigned pools. Because then, from a HTM lending institution, you become a warehousing company.
Right.
Right?
Okay. Yeah, so, correct. It's like a semi-DSA. Okay.
Yeah. You're just an aggregator, you mature the portfolio and sell it off.
Right.
And you become a servicing agent.
Right.
If you work in the US market, this is the model.
Okay. Sir, my second question is, sir, we are saying that we'll be looking to raise further capital at, we'll prepare ourselves at around 11 times gearing. Sir, it'll impact also our borrowing capacities and our rates, because higher the leverage, the lesser the banks would be willing to further lend you, right? It's got to do with, right.
Okay.
So how do we...
Now, business process re-engineering in true earnest only started from 2012. And in 2016, we were geared at 15 times.
Right.
And our IPO was well received and was the best IPO of the year. Right? And in that year, we had the maximum growth also.
Okay.
So, if your operational robustness over the period of time has been demonstrated well, the lending institutions do not raise an eyebrow just because of the lever.
Okay. But, sir, I'm just talking purely from what we're seeing from the market's perspective, because, like, I understand it's not in your hands, but PNB is trying to sell the stake, and it's finding it difficult to find a buyer for this. So, wouldn't that be an overhang saying that, okay, in fact, India Rating has downgraded our credit rating primarily because of the weakness of PNB, and also non-identification of the new buyer. So, don't you think so that further will impact our pricing when we plan to go for the IPO? It will, right?
Okay. This was the Valentine's Day gift of 2018 to us. And you will appreciate over the last 4 quarters, we have insulated the company's operations from this misgiving, which is not our doing. And I do not think I'm in a position to say they are not able to find a buyer. Okay. The company is at its lowest valuation. And I think it's the way the management team has sort of, again and again demonstrated, manifest that the company is very robust, strong, and is a national asset. So I don't think that prophecy of yours is correct. And I can't comment any further because, as I said, I'm not running the process.
Okay. So that will be it from my side. Thanks.
Yeah.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Sir, the last time when we spoke, you had indicated that in the corporate accounts, around 6 to 7 accounts are where you feel there is some sort of stress or some sort of delay in payment. How is the situation right now in terms of number of accounts? Has it changed?
Yeah, the number of accounts remain -1. One is cured, and we are working on the rest. And the remaining accounts are, touch wood, by grace of God, are working in a very robust and a sterling performance they are giving. So I would say our attention towards regularizing or curing these 4 or 5 accounts now has not got enlarged over the last quarter.
And secondly, on the fixed deposit, there has been quite a good traction in this quarter. What percentage of these deposits have come from online channel, online fixed deposit?
See, online we were doing fantastically well, and let me tell you, IBM this month is going to have an award ceremony in the Silicon Valley in SF. And this is an application which is getting an award because this is one of the finest applications which have been developed in partnership with IBM. Now, unfortunately, the Supreme Court ruled against eKYC on the liability side, and hence it had to be withdrawn. So as of now, the online deposit application is not live. We have withdrawn it.
Okay, sir. Thank you, sir. That's it for my side.
Thank you. Thanks a lot.
Thank you. The next question is from Sanjay Kullar from Infopile India. Please go ahead.
Congratulations, sir, for fantastic results. We have done better than expectations. My questions are on the two sides, sir. One is, sir, our NIM has come a little bit under pressure for the 9 months. Even it is vis-a-vis peers, it has been quite low. Would you like to give some outlook on that going forward? And secondly, what is our PPP profits?
Huh?
Pre-provision.
Okay, I will take first the NIM question, and you can repeat the second part of it. And see, the NIM compression, the gross NIM is at 326, which is very steady state. The net NIM is at about 285. And that has got compressed because of 2 reasons. One is obviously the level, which has gone up by about by 200 basis points. And the second thing is that we are carrying excess liquidity of about 6,000 crores. And that's an inventory holding cost which gets reflected in the NIMs. So I don't think that there will be further compression, and not to worry, because it was very important for us to maintain business as usual and not slow down operations even for a day for a rupee. And that was our promise of the leadership team to our teams on the ground. And we honored it like every other time, whenever we come across challenging situations. So I think because in a lending sort of a scenario, you should be more bothered about spreads rather than NIM, because then you have the gross NIM which has the fee income part and net off COA, etc. And if that is positive of 300 basis points and all, and you are able to control your OPEX, then it's a safe bet that your ROTA will be anywhere positive of 1.5, and if you are levered well, you can be returning the equity shareholders 18-19%.
Okay. So the other question is on the pre-provision profits. So how much is that for this current quarter vis-a-vis last quarter?
Pre-provision, we don't work because provisioning is part of our life. So I mean, in a lending institution, you don't work on a EBITDA concept at all.
Okay.
Right. So because in a lending institution, you will have to have provisions. So we don't even, look at it as a line item. Because if we are lending, we have to have provisions.
Okay, so thanks.
Thanks.
Thank you very much. That was the last question queue. I would now like to hand the conference over to Ms. Deepika Gupta-Padai for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript of this call will be uploaded on our website, that is www.pnbhousing.com. Thank you.